folks, it's Dave Burrows. I want to thank you all for joining this week's edition of our Barometer Readings webcast. I'm going to kind of go through a quick top-down view of the world. We're going to touch on some of the leadership themes that we're seeing in the market, talk a little bit about the portfolios and where we're focusing. Here we are on the other side of first quarter earnings. And I think that there's lots of insights along the way. So let me just start this week from the top as we normally do. We continue to think we're in a structural bull market that started in 2013. We continue to have the same characteristics we've had since then. A series of corrections along the way that came down and tested the 200-week moving average. Last one was October of 22. And in January of this year, we made a new cyclical high. And we're now 4 months beyond that. The month of April, of course, was a bit of a pullback. S&P pulled back at the worst point about 5.7%. And as we close out the day today, we're basically closing out at new highs. So the S&P 500 behaving well, much like it did all the way through the 80s and 90s, except for the fact that, we're probably a little more than halfway through what will ultimately wind up being, a bull market that goes on into the late part of this decade. As we've often said, when you make a new high coming out of a cyclical bear market, you tend to have sort of 2 to 3 years of pretty clear sailing before you get to the next correction. We watch, of course, all the time for any signs that might be taking place. When we look at the daily chart of the S&P, we saw the low in 22. We had a nice run up into August of 2023, where our indicators got a little bit more cautious. They turned higher again in October. We had a really great run higher into the highs in March. Our short-term indicators flipped a little bit lower at that point. Market pulled back, and of course, they flipped right back up again. So here we are trading very close to the highs. Now, not everything is participating. There's some sectors that are performing well, some sectors that are performing poorly, but certainly equities in North America have been acting well. What's interesting is that when we came out of the structural bear market in 2013, we started a new long-term bull market for U.S. equities, but the rest of the world, took a lot longer. So when we look at the Nikkei 1991 through 2022, we ultimately finally made a new high in 2023, and we've been working our way higher. Nikkei has been about the best performing market in the world of the major markets since March of 2023. India has been marching along since it came out of its bear market in 2021. The Euro Stoxx 50, just the last 5 months, getting up above the highs from the year 2007. Taiwan, made a high in 2001, didn't make a new high again into 2020. Of course, the concerns around the geopolitical tensions with China had the market pull back. Of course, the most important stock in Taiwan is Taiwan Semiconductor. So you can imagine that that's helped move the market back and get it back above the highs sort of from 2022. When we look at Latin America, a bunch of Latin American countries performing well. In many cases, these are countries that have very high inflation, and one of the only places to hide in a very high inflation world, even hyperinflation, is the stock market, because companies have an ability to raise price. And that's a lesson for us, because I think that we do have higher than typical inflation. It appears to be stickier than what people would have liked to see. And so we have to look at risks in different ways. One of them, of course, is that inflation eats your money. So if you look at Peru, if you looked at some of the African nations like Zimbabwe, the stock market going straight up because it's the one place that can help preserve purchasing power. So around the world, the equity asset class has a bid, and of course, the Canadian market does as well. We're trading basically at new highs for the year after a very long time, the market working its way from the previous high in 2008 to make the new high in 2021. And it looks as though we've just started another leg higher. Common characteristic among a bunch of these global markets, the big sectors tend to be financials, industrials, materials, and energy. Of course, that represents Canadian market, which is why the Canadian stock market tends to act more like global stocks. So most people know that watch this webcast, we have been adding exposure to global equities through the course of this year. For many years, people didn't make money in global equities. We certainly weren't focused on them, but they seem to be in gear. The sectors that make up global markets are in gear. And so we want to have some exposure because they are really less expensive than the US stock market and have a very different sector makeup, so they're a good diversifier. In the world of fixed income, we had the generational low in interest rates. Rates fell from 1981 to 2020. They've been working higher since then. This is the march higher in the 10-year yields, as opposed to seeing a series of lower highs and lower lows in a disinflationary world. We're seeing higher highs and higher lows since then. So we're now 4 years into a fixed income bear market. And while many people think that bonds protect us from important risks, one of them being disinflation, they may not be so helpful in an inflationary world. In fact, if you were to look at the 30-year US Treasury, it is on track for the worst annual return since 1919, after already having, 3 very poor years. So we continue to believe we're in a bond bear market. We're not interested in fixed income exposure other than in what has to have fixed income, a balanced mandate. And we continue to like stocks versus bonds. Since the bottoming in rates, if we compare the S&P 500 versus the aggregate bond index, the relative price performance has been clearly on the side of equities, which is why we've leaned into equities. And in particular for income investors, we've been leaning into dividend growers versus high dividend payers. Dividend growers are companies that tend to generate a lot of excess cash and are continually growing the cash they're generating, and they show a willingness to pay them out to shareholders. This is what worked in the period of the 1950s and 60s, the previous period where rates bottomed and then went higher for 25, 30 years. Dividend growth led the party. So if we compare the RDVY versus the FDL ETF, which is a high dividend payers ETF, very clearly, dividend growth is leading. So that's the most important theme, I think, for more conservative investors. Dividend growth is the way we want to go, and that's what we focused on in our income portfolios. When we look at commodities bottomed in 2020. We had a first big leg up. We had a global tightening cycle. And now over the last 3 months, commodities have started to lift again. We think we're in the second wave of what will likely be 3 long-term bull markets in commodities, likely last longer than a decade. It tends to last 10 to 15 years. And they tend to start after a period of underinvestment. And we can understand why, if prices were falling from 2011 through 2020, why companies would slow down their investment and not find new deposits and capacities. And of course, that's what tends to happen. So commodities relative to bonds, showing that hedging against inflation is more important against hedging against falling prices. Commodities outperforming smartly. And interestingly, when we look at gold, for instance, for the first time in 45 years, gold is less volatile than a treasury bond, which is why in our macro portfolio, we have about a 10% weight between gold and silver, which have been performing remarkably well. Commodities relative to the equally weighted S&P, again, put in a bottom in 2022 and looks as though they're starting to lead once again. So these are the big picture asset classes that we're focused on. I think that this is important. It points to the fact that we're in a more inflationary world. The market is telling us that, and we don't have to be everywhere, right? Our job is to focus on market leadership. We're always watching for change, new signs of leadership emerging, and old signs of leadership waning so that we can adjust the portfolios and keep them relevant. And of course, if there was an absence of leadership, we're very happy to sit on the sidelines. So our job is to be tactical. We're being hired to make money, not to be invested. and where we see opportunities, we're going to focus. We use our three-prong process, where we think that 70% of return comes from getting to the right neighborhood, so focusing on the right asset classes and sectors within those asset classes, and then populating our portfolios, identifying securities in our bottom-up process that are good getting better. We're trying to find the leading securities in groups that people care about. And that's where our portfolio should live. It may mean we avoid entire sectors. It may be we're focused in a more narrow part of the market. Depends on the market environment we're in. Of course, we use stop losses on all of our positions because our first and number one job is not to let a little mistake turn into a big one. And we know investing is not about being perfect. So our top-down work is aimed at finding improving breadth. And last week, we highlighted that our long-term breadth models that track the percent of stocks within each market that are performing well had been expanding. So the percent of stocks in uptrends had been expanding, and different ways to measure that: the percent of stocks trading above the 50-day moving averages, percent of stocks with positive weekly price momentum, percent of stocks making new highs versus new lows, and percent of stocks trading above the 150-day moving average, all were improving. Well, this week, the market wobbled, and some of the short-term indicators showed some weakness. So this is something that we're going to watch. And I'll highlight as we go through some of the areas we see weakness. Fortunately, there are areas that we've been avoiding. In general, bullish percent, or the percent of stocks in uptrends, was stable, but under the surface, a little bit of weakness. And I highlight that as the S&P has been rallying since December, on the first push higher, 92% of stocks were trading above their 50-day moving average. Then the market pulled back a little. In the next rally push, we got to only 85% of stocks participating. And on the most recent push, only 50% of stocks participating. So what does that mean? It means the market is becoming a little bit more focused. Certain companies and sectors benefiting from the current environment, others, investors, getting concerned and maybe pulling in their horns. So we're going to talk about that a little bit. So let's talk leadership. Now, off the top, we came through an earnings period, which was generally pretty good. Earnings beat estimates by about 5%, and revenues beat estimates by low single digits. So there were some disappointments for sure, but in general and in the aggregate, earnings came in pretty good. When we look at the consensus path for earnings for 2024, as we sit right now, they have been rising so far over the course of the year. Now that's interesting because generally analysts start the year optimistic, and over the course of the year realize maybe they're being too optimistic, and they tend to revise their earnings down through the course of the year. So bottom-up analysts, single stock bottom-up analysts, when they do their work currently, they point to the fact that actually earnings look to be pretty resilient and certain parts of the economy very strong. But we can see when we look at parts of the market, which areas they expect to be strong and which areas they expect to be weaker. So we'll start out with financials, because financials make up about 25% of our firm assets. Now, financials in general are companies that do well in a rising rate environment. If we use the saying I've been using over the course of the year, we went from 40 years where the when the borrower was in control during falling interest rates, they benefited from lower and lower rates. We're now likely in a world where the lender is in control and they have the ability to make a margin. If we take the universe of capital markets, banks, and asset managers, we see prices have been moving smartly higher since last October. And this is the relative strength versus the S&P. It has been rising steadily. This ETF is traded better than 85% of all of the companies in the S&P over the last 52 weeks. And it's made up of companies like Northern Trust, Morgan Stanley, Goldman Sachs, Raymond James, Charles Schwab. These are names we know. So, pulled back a little bit today, but literally on Friday made new 52-week highs. Insurance in general has performed well. We've talked a lot about some of the property and casualty companies we're in, like Fairfax, which is the #1 holding in the firm. Progressive is a top 10 holding also. And Manulife is just outside our top 10, made a new relative strength high yesterday before pulling back a little bit today, trading better than 80% of companies. So the financials continue to behave well, and they should, because we've talked about, like in markets, when you eventually make a new high after a long period of time, this is 2007 through 2021, generally it means you've started a new bull market. This is the tightening cycle, and we now have 1, 2, 3, 4, 5, 6 months, a little pullback in April, and now moving higher again in May. So very early stages for a new structural bull market in financials. And in general, around the world, financials are an under-owned asset because they did underperform for so many years, going back to 2007. When we look at industrials, in general, relative strength has been rising since October of last year, but you can see over the last couple of weeks a little bit of relative weakness. We made a high in March, and then we made another high in April. We pulled back over the last week or so. So we'll see whether that turns into something. We think it's more stock specific. When we look at the mid-sized companies that are selling into the infrastructure world, we talked a little bit about power infrastructure over the last couple of weeks. We can see that the mid-sized industrials that are more domestically focused are really outperforming. Great performance here. And of course, defense is a group that continues to relatively outperform. And we've talked about Howmet Aerospace as being a top 10 holding for the firm. They make forged parts and fastening systems for the defense companies, made a new 52-week high today, trading better than 96% of companies in the S&P. So again, trying to be targeted. Materials. Materials made a high in 2021, consolidated and started a new leg higher over the last couple of months. But I want to point out how important this is. Last week, we talked about what extent we could see these rally over the next number of years. Well, we know that when commodities go through a long bear market, when they eventually get going, they really can generate big returns. This little 3-month move here that we've seen in the copper producers is 45%. So this is a 45% lift in the index of copper producers. So we look at a company like Teck Resources. We pointed out what happened in the last bull market, up over 1,000%. Okay, great. It's up 47% in the last 3 months. Looks like we're making new highs. Looks like we've begun another leg higher. But it's the very beginning and something that likely will go on for a long time. Now, there's good reason for that. Now, we've just gone through the period during the year where there's a seasonal surplus. Generally, in the first quarter of the year, as per Goldman Sachs, there is a surplus of capacity in the world. And then you work your way into deficit, second quarter, third quarter, and fourth quarter. The expectation is for a significant deficit globally in 2024, more significant than 23. And again, more significant in 25. We want to own things that have pricing power. And the producers of copper look as though they have pricing power because we're just not producing enough of it. Not only that, as we've gone through a bear market in commodity prices, drilling activity over the last number of years has been falling, which means that we're finding less new deposits. So not only do we have a deficit, but there's not a lot of new supply coming along. We like those dynamics. The gold market is similar. We talked a little bit about Agnico Eagle over the last little bit. It's moved up 45% in the last 3 months. Again, I think it's the beginning of something. The last structural bull market that went on from 2000 to 2008, Agnico rallied just over 1,000%. So we'll see. We'll see whether our work continues to point to these groups, but we do think that we're getting very clear indication that we've begun a more significant rally. Same thing in the uranium stocks. Cameco would be one of our key holdings. You know, it's had a sharp move higher, $53 to $73 over 3 months. But again, looking at previous bull markets, this would be a relatively small start. So the material stocks continue to perform well. When we look at energy, relative strength for energy since January has been moving nicely higher. If we take the XEG ETF, which is made up of the Canadian large cap producers, you can see that we've consolidated over the last few weeks, very close to making new highs and virtually at new highs. We look at some of the leading stocks that we're focused on in our top 10. Canadian Natural Resources, came out of the bear market in 2021, moving smartly higher. Who wouldn't like this? They're growing their earnings at 20%. They're growing their dividend at 20%. It's already a 5% dividend to begin with. Last bull market, again, the stock moved smartly higher. Imperial Oil is very similar. So the energy sector continues to perform well. The basic materials sector continues to perform well, both inflation protecting sectors, and interestingly, both very small sectors in the S&P. Energy about 5%, materials about 2.5%. And many people are completely void of these stocks. I understand they've been disappointing for many years, but they certainly are not disappointing currently, and we think that they've started something bigger. When we look in the context of previous bull markets for energy, we can see that March of 20 to 24 represents something that is relatively short term relative to what's happened in the past. So we'll see, and we'll continue to monitor. Let's move on. So this week was an important week, or last week was an important week. NVIDIA reported their earnings. This is the XLK ETF. We've talked about the fact that relative price performance has been sort of neutral over the course of this year after being very, very strong over the last year. NVIDIA is the third largest holding in this ETF and certainly didn't hurt it over the last week. They reported their earnings, cash flow, orders, sales, all sharply higher. So strong that we moved from $900 a share last week at this time to today at $1,138, up $240 over the course of the week. We're very happy about that, trading better than 98% of all the companies in the S&P over the last year. This has been an absolute dynamo. I think our cost here is $140 a share. As I think most people know, they're going to split 10 for 1. And generally, when a company like this reports a split, it does run up into the split. So we continue to be quite bullish here. The other areas of tech that have behaved well, we've had to be very disciplined and focused, have been the dividend growth oriented companies. And two of the largest dividend growers are Broadcom and Microsoft. This is the TDIV ETF. It's made up of tech dividend payers, maintained its relative strength, but over the last month, again, has been moving sharply higher. So, we continue to like these. NVIDIA, Broadcom, and Microsoft are in the top 10 holdings at Barometer. There's the Broadcom shares, better than 92% of companies in the S&P, and very steady rising relative price performance. Broadcom, as many people might know, design chips for third parties, and they have software to aid in that work. And of course, there's a lot of semiconductor chips being designed currently. Amazon, Apple, Microsoft, all working at developing their own chips that may compete ultimately with NVIDIA. Utilities. Utilities have had a nice move higher since February. As we talked about, we added 2 positions over the last 3 months, Southern Company and NextEra. NextEra made a new 52-week high today. Again, new relative high, continues to act well. And that's on the back of expectations for growth and power demand from data centers and semiconductor manufacturing. And then on the other side, let's get to the weak parts. Boy, these groups and investors in these groups must be very, very frustrated. Telecom continues to make relative new lows. Dividends great, but the share price is behaving horribly. So one of the interesting characteristics is as rates have moved higher and as bond prices have been sloppy, things that act like bonds also have been weak. So the more defensive parts of the market that don't have the ability to raise price are having very poor relative performance. Sadly, this is where more conservative investors have focused. So telecom, historically, a nice, safe part of the market, relative strength has been getting crushed all through the year. Healthcare, relative performance weak. Outside of companies like Lilly or Vertex, very hard to make money in this group. The XLV was down 1.5% today after making a lower high. This is a group that we continue to avoid. High multiple earlier stage companies, especially. This is the genomics ETF. If we look at biotech, it's similar. From a real estate perspective, again, the power is not in the hands of the borrowers. The power is in the hands of the lenders. We've all read a lot about what's going on in the commercial real estate area and residential, very sloppy, relative price performance weak here. And as you can imagine, with rates on mortgages and auto loans resetting, the consumer is pulling in its horns. I listened to the Scotia quarterly conference call today. They talked about among their variable rate mortgage holders and fixed rate holders, they can see a pullback in consumer spending. Variable rate mortgage holders about 10% and fixed rate mortgage holders about 5%. And we know that there's lots of rate resets going to come over the next 3 years. So we're being very cautious on the consumer. Relative price performance tells us that the market believes there's some weakness here. And outside of things like, sorry, I'll come back to that. Outside of things like the dollar stores, even consumer staples, which are typically more defensive, continue to see very weak relative price performance. So you can imagine this is some of the things that people use as staples. We think that we want to focus in areas that cater to a consumer that's pulling in their horns. Dollarama has been performing remarkably well, and Costco today made a new 52-week high. So we really have to pick our spots. There's areas that are weak and areas that are strong. High multiple technology, the ARC Innovation ETF made up of some of the highest multiple tech stocks, continuing to have a tough time again. Higher rates mean you have to discount future earnings back to the present, which means they're worth less. So we take all of the sectors that we can focus in and look at what's happening from a breadth perspective. If we take the 41 sectors that we track and place them on a distribution curve, looking at which sectors have the highest percent of stocks performing well, the sectors at this end of the spectrum have the best breadth. And they include insurance, electric utilities, banks, Wall Street, forest products, that's materials, aerospace, oil service, precious metals, chemicals, semiconductors, steel, metals. These are the groups that we've been highlighting. On the far end of the spectrum, the sectors with the smallest number of stocks performing well, and the ones in small letters are seeing things get worse, not better. So when we look at the consumer, leisure, auto, restaurants, and in here is housing somewhere, you can see they're all weakening. We see biotech as being about the weakest group. Now we watch for signs that breadth starts to expand. And when it does, we'll put on a position, as we did in utilities, and utilities have acted really well over the last 3 months. So while under the surface, some sectors are having a difficult time, some sectors are performing really well. It means that we have to be targeted. It means that there's an opportunity, if you're an active investor, to build a portfolio that looks differently than the index. And we do. Financials would make up the largest weight of our portfolios, about double weight the S&P. Energy, again, about 2.5 times the S&P's weight. Technology, we have an underweight, but we're very targeted in 3 big names that are significantly outperforming the market. Our industrials exposure has just been taken down from 13% to 9.6%, as we saw some deterioration in the relative price performance in the industrial sector. Healthcare is an underweight, communications or telecom an underweight, staples a significant underweight, utilities a small overweight, Discretionary is significant underweight. Real estate is significant underweight. It's a market of haves and have-nots. And I would hope that we're going to see the market broaden out and have more of these sectors participate. It gives us greater ability to diversify, as opposed to building portfolios that are made up of equities and bonds. To get diversification, we're making up portfolios of equities and commodities. And I think those are helping us to diversify out the biggest risk, which is inflation. And it's working pretty well. Since the market started to broaden in the middle of March 2023, the equally weighted S&P is up 22%, TSX up 19%, the aggregate bond index up 1%. Our tactical income portfolio is up just about 28%. Equity portfolio is up 34%, and our global macro portfolio up 32%. Year to date, S&P, equal weight S&P up 5.59, TSX up 7.75, aggregate bond index down 1.5, income's up 14, equities up 14, macros up 12.6. And then on the global front, the MSCI All World Index ex-US is up 7%, TSX up 7, aggregate bond index up 1.5, our new global fund up just about 11%. It shows that by targeting some of these themes, we can make a significant difference. My fear is that people are all piled into a couple of groups, and one of the big ones is technology, and there's some great companies there, but it is not outperforming the market in general, and some of the more defensive sectors really continue to look pretty choppy. Now, credit spreads are narrowing, meaning there's no major concern around credit. Volatility remains quite low. And so here we are at the beginning of summer. And we talked about the fact that in an election year, it tends to be actually summer's a little bit better. I thought you might be interested to see this. If you take the 3-month seasonality for presidential election years, all the way back to 1928, and look at what happened in these periods. You know, I keep getting asked, sell in May and go away. Is that a thing this year? As it stands right now, it doesn't look that way. When we look at the presidential re-election years, May to July, in the fourth year, going back, an average of 2%. Now we're headed to the end of May. June to August, 7.27% versus the average of all years, 3%, or a 4% outperformance going back over all years. July to September, 5.21% versus 1.28% for the average of all years, and August to October, 2.07% versus a negative return for the average of all years. So seasonally in an election period, we should be headed into a stronger period. Our long-term models are positive. We'll see whether they continue to be, but the sectors that we're focusing on are performing quite well. Now, so far in the month of May, we're up 5.35%. Market's behaving constructively, and there's very clear leadership. If things start to change, we'll change the portfolios and we'll get more defensive. But as it is right now, we think that the portfolios are in a pretty good spot. Now, I don't have Pamela here today to help find questions. I'm going to take a look and see if there's any questions that stand out. I apologize if it takes me a little bit longer. From Alejandro, regarding nuclear stocks, do you think Cameco has done a cup and handle formation like gold did in the long term? So, Alejandro, I think that the uranium companies, the copper companies, the gold companies, all are behaving in a similar way. They've come out of long-term bear markets. We've only just begun what I think is likely a secular bull market for commodities. And we're getting a nice blast off over the last 3 months to signify that. So this is something I think that we want to focus on. I think that's it. I don't have any other questions. I'm surprised. Maybe everyone's gone to the golf course. Okay, thanks everybody for tuning in. We'll continue to watch. Don't hesitate to follow us on @Barometer.ca. We do post stuff over the course of the week. We try not to burden you with too much stuff. And if you got questions that we're not answering, please reach out. I know that we've been working through review calls with most clients. And if we haven't spoken to you recently and like to have a conversation, please let me know because we want to make sure we get to everybody. And if you're not a client, you got questions, again, don't hesitate to reach out. We're in the business of building this company, and hopefully we're doing a good job for clients. So thanks very much. Everybody have a great week.